The stock market is a wild ride, and this week is no different. President Trump threw a curveball with a 25% tariff on imported cars and parts. Auto stocks took a major hit. GM plunged over 7%, Ford dropped 3%, and even Stellantis skidded 1.9%. Trump says he doesn't want car prices to rise, but come on, man. This tariff is going to cause chaos in the auto industry. These tariffs are a major threat to American businesses and consumers. They will drive up costs, reduce competition, and stifle innovation. The administration should reconsider these policies and focus on promoting free trade and economic growth. This is a developing story, and investors are right to be concerned. The auto industry is a major driver of the US economy, and these tariffs could have a significant impact on growth and jobs. Stay tuned for more updates as the situation unfolds. GM got slammed the hardest by these tariffs. Why? They make a lot of cars outside the US. Think about it, 30% from Mexico and Canada, another 15% from South Korea. This tariff is a direct blow to their bottom line. GM is in a tough spot. They need to find a way to cut costs or raise prices. Otherwise, their profits will take a hit. Investors are watching closely to see how they respond. This is a critical moment for the company. The tariffs could force GM to rethink its global manufacturing footprint. They might have to move production back to the US to avoid the tariffs. But that would be expensive and could lead to higher prices for consumers. Ferrari, on the other hand, is laughing all the way to the bank. They're slapping a 10% price hike on their cars in the US starting April 2nd. You think their wealthy customers care? Not a chance. They'll pay anything for a prancing horse on their hood. Ferrari is a luxury brand, and their customers are less price sensitive. They're willing to pay a premium for exclusivity and performance. The tariffs are just a drop in the bucket for these high rollers. This move shows that some companies can pass on the costs of tariffs to consumers, but most businesses, especially those selling to price-conscious consumers, will struggle to do the same. Eli Lilly got some bad news this week. Their Alzheimer's drug, Kisunla, got rejected by European regulators. They said the benefits didn't outweigh the risks. Ouch, that's gotta hurt. Lilly's stock took a hit on the news. This rejection is a setback for Eli Lilly and for Alzheimer's patients. The drug showed promise in clinical trials, but regulators are concerned about its safety and efficacy. Lilly will need to conduct more research to address these concerns. The pharmaceutical industry is facing increasing scrutiny over drug pricing and safety. This rejection highlights the challenges of bringing new drugs to market, especially for complex diseases like Alzheimer's. Section 5, GameStop's Bitcoin gamble. Remember GameStop, the meme stock that went to the moon? Well, they're at it again. They're closing stores and going all in on Bitcoin. You heard that right. They're betting the farm on the crypto craze. The stock soared 16% on the news. This is a risky move for GameStop. Bitcoin is a volatile asset and its price could crash at any moment. But if it pays off, GameStop could become a major player in the crypto space. This is a high-stakes gamble that could make or break the company. The move highlights the growing influence of cryptocurrencies on the stock market. Investors are looking for the next big thing, and some believe that Bitcoin and other digital assets are the future of finance. Section 6, Lululemon feels the squeeze. Even Lululemon is feeling the heat. They beat earnings estimates, but their 2025 guidance was weak. They're blaming inflation, tariffs, and economic uncertainty. Investors weren't happy and the stock plunged over 10%. Lululemon's struggles are a sign of the times. Inflation is eating into consumer spending and tariffs are raising costs for businesses. The economic outlook is uncertain and companies are being cautious with their forecasts. This is a reminder that even strong companies are not immune to macroeconomic headwinds. Investors need to be selective and focus on companies with strong fundamentals and a clear path to growth. Section 7, Inflation and Spending, a mixed bag. Let's talk inflation. Core inflation came in hot at 2.8%. That's higher than expected. Consumer spending edged up a measly 0.4%, which is weaker than expected, but personal income jumped 0.8%, double what analysts thought. The inflation data is concerning. It suggests that price pressures are building in the economy. The Federal Reserve is likely to raise interest rates more aggressively to combat inflation. This could slow down economic growth. The strong personal income growth is a positive sign. It suggests that consumers have more money to spend. However, rising inflation is eroding their purchasing power. Section 8 debt warning looms large. Hold on to your hats, folks. The Congressional Budget Office dropped a bombshell. They're warning that US debt could hit 118% of GDP by 2035. That's insane. And you know what's even crazier? Trump wants to extend those tax cuts. This is a recipe for disaster. The rising national debt is a serious threat to the long-term health of the US economy. It could lead to higher interest rates, slower economic growth, and a weaker dollar. The government needs to get its fiscal house in order. This issue is likely to become a major political football in the coming years. Lawmakers will need to find a way to reduce the deficit and put the country on a sustainable fiscal path. Section 9, global tensions and market jitters. The world is a mess right now. We've got earthquakes in Myanmar, drone strikes in Beirut, and trade tensions with China. Gold just hit a record high as investors seek safety. Oil prices are also on the rise. It's enough to make you want to bury your money in the backyard. These geopolitical events are adding to market uncertainty. Investors are worried about the potential impact on global growth and corporate profits. This is leading to increased volatility and a flight to safety. The markets hate uncertainty. Until these geopolitical risks subside, expect continued volatility and a cautious approach from investors.